here's something almost every Australian ETF investor gets wrong, and it has nothing to do with picking the right fund. It's what happens after you buy it, when the tax statement lands in your inbox every July, packed with numbers nobody explained to you. You bought VAS, you bought VGS, you did everything right, and then this one document shows up, full of terms like AMIT cost basis net amount and attribution, and suddenly it feels like the tax office is speaking a different language. Here's the problem. This isn't a mistake people make because they're careless. It's a mistake people make because ETF tax in Australia is genuinely structured differently to owning a normal share, and almost nobody explains why. So let's fix that properly, from the ground up. Financial educators and accountants who work with everyday investors report the same pattern year after year. People either ignore their annual tax statement completely, or they only read the top line, the cash distribution, and skip everything underneath it. That single habit is one of the most common reasons Australians overpay or underpay capital gains tax when they eventually sell their units. So here's what's actually going on, and why it seems simple, but really isn't. When someone buys shares in a company like a bank or a miner, the tax story is straightforward. The company pays a dividend, sometimes with franking credits attached, and that's basically it. An ETF is a completely different animal. When money goes into an ETF, it isn't buying a slice of a company, it's buying units in a trust. The ETF holds a basket of underlying investments, and legally, income earned inside that trust has to flow through to the people who hold units in it. That's the entire structure. Money and tax obligations pass through the fund and land on the investor's own return, as though the investor owned the underlying assets directly. That flow-through mechanism is exactly where things get complicated, because the fund doesn't always distribute in cash the exact same amount as the taxable income it has to attribute to investors. And that mismatch is where core complexity number one comes in, the AMIT regime. AMIT stands for Attribution Managed Investment Trust. It's the tax framework that almost every major ASX-listed ETF operates under. Names like Vanguard, BetaShares, iShares, and VanEck all use it. Under AMIT, the fund attributes specific amounts of income, capital gains, and foreign income directly to each investor based on units held, rather than relying on the older, clunkier model of present entitlement. Here's the part that trips people up. Sometimes the taxable income attributed to an investor is more than the cash they actually received. Other times it's less. Whenever there's a gap between the two, the fund makes what's called a cost basis adjustment. Picture this. An investor buys 1,000 units of an ETF at $90 each. Total cost basis, $90,000. Over the following years, that ETF issues annual statements showing small cost basis decreases, say 75 cents per unit across a couple of years. That might sound harmless, but it means the investor's real cost basis has quietly dropped to around $90,750 less than what they originally paid. Naturally, the next question is, why does this even happen? Shouldn't the fund just distribute what it earns? Not necessarily. ETFs regularly rebalance their portfolios to match their index, and that rebalancing can trigger internal capital gains events. On top of that, sometimes a fund distributes less cash than the taxable income it has to attribute in a given year, commonly because of tax-deferred or return of capital components. When that happens, the ATO's rules require the investor's cost basis to be adjusted downward because that extra value hasn't been taxed yet. It gets taxed later as a bigger capital gain when the units are eventually sold. This is the single most overlooked number in Australian ETF investing. If someone ignores it and simply subtracts their original purchase price from their eventual sale price, they will understate their capital gain. And if the ATO's data doesn't match their tax return, that's exactly the kind of discrepancy that draws attention. So where does someone actually find these numbers? That brings us to the paperwork. Every year, ETFs that operate under AMIT are required to issue what's called an AMA statement, an AMIT Member Annual Statement, generally within 3 months of the end of the financial year. Think of it as the master decoder ring for everything that happened inside the fund on the investor's behalf. A typical AMA statement is broken into sections. There's usually a summary of income components, franked and unfranked distributions, franking credits, foreign income, and any foreign tax already paid. There's a capital gains section showing discounted and non-discounted gains the fund itself realized through its own trading and rebalancing. And critically, there's the cost basis adjustment section, the increases and decreases that need to be tracked parcel by parcel for as long as the units are held. Each of these numbers maps to a specific label in the ATO's system. Managed fund distributions typically get entered under specific codes for non-primary production income, for capital gains components, for the foreign income tax offset, and most major ETF providers pre-fill much of this directly into MyTax. That said, pre-filled data can lag or arrive incomplete, so cross-checking the actual AMA statement before lodging is genuinely worth the 10 minutes it takes. Now, once someone actually sells their ETF units, a second layer kicks in. Core complexity number 2, capital gains tax on disposal. Here's the key distinction that catches people out. Nothing is reportable for CGT purposes just because units are held. A capital gains tax event is only triggered by a disposal, selling units on the exchange, transferring them off-market, or otherwise disposing of them. Simply holding an ETF through a volatile year, watching the price swing up and down, creates no CGT obligation whatsoever. When a sale does happen, the calculation starts with the adjusted cost base, the original purchase price, plus any AMIT cost base increases, minus any AMIT cost base decreases, accumulated across every year the units were held. Subtract that adjusted cost base from the sale proceeds, and the result is the capital gain or loss for that parcel. If units were held for 12 months or more, current rules allow individuals a 50% capital gains tax discount, meaning only half of the net gain gets included in assessable income. It's worth flagging, though, that this 50% discount has been under review. The federal budget in 2026 proposed replacing it from the 1st of July 2027 with cost-based indexation and a 30% minimum tax on capital gains. As it stands, that change isn't yet legislated, and current rules continue to apply for now, but it's a space worth watching, especially for anyone weighing up when to sell. One more twist worth knowing. If units were bought in different parcels at different times and different prices, each parcel keeps its own cost base. Selling only some units means choosing which parcel to sell, commonly using a first-in, first-out approach, though other methods are allowed, and that choice can materially change the size of the reported gain. So, practically speaking, what should someone actually do with all of this? Start with the ATO's own resources. The Personal Investor's Guide to Capital Gains Tax, published annually, walks through exactly how to treat distributions from managed funds and ETFs. And the ATO also provides an online capital gains calculator for working through the mechanics step by step. Most ETF issuers, Vanguard, BetaShares, and others, also publish their own plain English guides to reading an AMMA statement, tailored to that specific fund. Whatever the source, always double-check the pre-filled data in MyTax against the actual statement before lodging. Pre-fill is a convenience, not a guarantee. And for anyone holding a straightforward single ETF portfolio with modest distributions, working through the numbers directly or using ETF tracking software is often entirely manageable. But for portfolios with multiple parcels, foreign domiciled ETFs, or capital gains sitting anywhere near 5 figures, getting a registered tax agent involved isn't overkill. It's simply proportional to the complexity involved. Before wrapping up, a few quick, practical habits worth building. Record every AMA statement the moment it arrives and update the cost base for that holding straight away. Don't wait until the units are sold to try to reconstruct years of history. Keep records for at least 5 years after the relevant tax return is processed, since the ATO can request supporting documentation well after lodgement. And here's one worth repeating. Don't rush to lodge in early July. Pre-fill data for managed funds and ETFs is frequently incomplete in the first few weeks of the new financial year, and lodging before it settles is one of the most common and most avoidable causes of amended tax returns. Understanding how ETF tax actually works in Australia isn't about memorizing jargon for its own sake. It's about making sure the numbers on a tax return actually match what's really been earned, no more, no less. Track the cost base every year, read the AMA statement properly instead of skimming the top line, and get the professional help proportional to the complexity involved. That's how ETF tax in Australia actually works.